Hey everyone, welcome to this very quick video on the risks associated with hedge funds. This video is not intended to be a comprehensive list of all the risks to investing in hedge funds, but it's just a little one to give you an idea of some things that you can look for and be mindful of course. As with this video and many others, this forms part of a series, so head to the Rask Finance website to watch the whole video series and to take our quizzes and tests and really test your knowledge of finance and investing. Okay, so what are the risks associated with hedge funds? Now I'm just listing some of the most common. Of course, you should really read the marketing material and some of the less shiny marketing material in particular before investing in any type of fund or strategy. But I've named a couple of the most common here. So let's start. Key person risk. So this is the risk associated with the one individual or the two individuals or the three individuals that have all the knowledge. So typically what we see in hedge funds is that there's one guy or girl who's really smart, really driven, really motivated to succeed. But if something were to happen to them, if they were to get hit by a bus, it's unlikely, but if they were, or if they stopped wanting to be a part of the business or whatever it may be, if they are not part of the business, the hedge fund might not perform anywhere near as well. And if they're really good at their job, they might leave and then all the clients go with them and you're left in this fund with nowhere near as much money and with a second-rate investor. The market risk, sorry. So what is market risk? Market risk is effectively that the strategy doesn't work according to plan. So something might happen, like there might be an unprecedented shock to the financial system that the hedge fund hasn't accounted for, and because it's using some sort of weird strategy and weird and wonderful strategy, something might happen to it and it hadn't expected that to happen, and then something goes really wrong. Market risk is the risk associated with pretty much any type of investing, but depending on the hedge fund strategy you choose, it might be more affected or less affected. Marketing risk, and this comes with something called backtest. When you've read enough about hedge funds and managed funds more broadly, you'll know that many different types of hedge fund managers like to produce something called a backtest. This is when they have a strategy and they say, hey, if we were around for the past 20 years, these are the returns we would have got, and look how we've tested them. Now, what happens is you might devise a strategy, so it might be what we call a systematic strategy, where it's really just rules-based. If this happens, then buy that. If this happens, then sell that. And what you can do is you can use that strategy and then you can run it through a data set going back, say, 20 years or 10 years or however long you have. And you can then produce what would have been hypothetical, or what would be returns, so hypothetical returns. And you can say, if only we were around 20 years ago, this is how well we would have done. Unfortunately, what happens in the marketing and in backtests specifically is the future is different to the past. It may, what they say, it may rhyme, but the future doesn't repeat itself. So that's really important to be mindful of. Just because something happened in the past, it won't happen in the future, or it may not necessarily happen. That's why the number one disclaimer you'll ever read is past performance is no guarantee of future success. So that's this one down here again. Past performance is no guarantee of future success. Just because the hedge fund has done well in the past doesn't mean it will work going into the future. Now that creates some uncertainty because you can say that about everything, right? But that is just a fact. You can't guarantee future success, and anyone that tries to guarantee returns for you are more than likely misleading you. So just keep your wits about you and don't fall foul for the idea that something is guaranteed or a risk-free investment, because if it's risk-free, then it's not an investment. Okay, so liquidity is the final risk I have here. Typically what happens when you invest in a hedge fund is there'll be a pool of money and you'll invest your money into that fund, and what happens is then that fund manager invests that in whatever they think is going to go up in price, right? So you invest your money into the fund, and then it invests in many other things. With hedge funds, some hedge funds, this is not all hedge funds of course, some hedge funds invest in things that are very illiquid. So what we say is they're very difficult to get your money in and out of very quickly. And now that it's okay to invest in illiquid investments when things are going well, but it's always when things are going poorly that you try and get your money out. And this right here may be harder than what you think it is, or what the fund manager thinks it is, to get their money back into the fund and then pay the money back out to you. So there's two types of liquidity here. We have this one, which is associated with the investments that they make, but we also have the risk that it might take a bit of time to get your money actually out of the fund. So most people just think that this is what happens. You want to get your money out, you say to them, I want my money back, and you get your money back within a couple of days or weeks. That's okay, and that's normally what happens, but sometimes when things go wrong and they're invested in illiquid assets, they'll struggle to return the money to you. So for example, during the GFC, hedge funds that were investing in property or in some type of weird and wonderful assets that they thought were doing really well before the GFC, they turned out to be extremely illiquid when everyone tried to rush out and sell their position, and they couldn't get money back to fill the orders of their clients. So the fund froze, or in worst cases, it imploded or exploded. So you don't want that to happen. So liquidity is a really important one. Obviously, more liquidity equals easier to get money in and out. We've covered that in a separate video on the Rask Finance website. Okay, so those are some of the brief, there's a brief introduction to some of the risks. There are many more. Head to the Rask Finance website if you have any questions. I'm Owen Raskovich, and cheers to our financial futures.